there's certain investors that they want to know the deal, they want to underwrite it, they want to know the borrower, they want to know where it's at, and if we have to foreclose on it, knock on wood, they want to feel confident that they know exactly what deal they're getting. Then there's also the investor that is, here's $100,000. I want my monthly distribution. I don't want to know anything about it. I trust you. Go do that. And so I didn't know that we would run into that hurdle until we started raising for the fund. And it was a very like, oh, okay. Like we almost have to source a different type of investor for the fund.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Will Coleman is a real estate investor and debt fund operator that does hard money loans in Nashville, Tennessee. Hey, good to have you on the show here, Will. Good also to have a fellow Tennessean on the show. I don't get to have this very often. Will, there are 3 questions I ask every guest who comes on the show in 90 seconds or less. Can you tell me, where did you start? Where are you now? And how did you get there?
Awesome. So yeah, started in Texas, working at a commercial real estate bank, as well as being a leasing agent. And then I'm a hard money lender in Nashville, Tennessee. We operate a debt fund, and long story how I got there, but I went from commercial real estate bank, to purchasing some units, to starting and building a commercial mortgage business, and eventually got to being a hard money lender with me and my business partner, Brandon Thornberry.
That's great. Absolutely. That's very, very efficient. That's a lot of moving pieces. I mean, I don't know how old you are. I would guess that you're a lot younger than me. Just looking at the camera here, I got a lot more wrinkles maybe than you do. And that's a lot of steps along the way. How did you, I guess, as you moved through those various steps, how did you move with confidence knowing that the next one was the next best thing in line for you to do?
Yeah, that's a great question, Sam. I took a lot of wrong steps for sure.
Okay.
And I would just, I followed the next thing, and some worked and some didn't. And each one I learned something great, and each one allowed me to have more confidence in the next step.
No, that's good. What about getting all the way to hard money lending? That's a far step from a leasing agent. What sparked that idea for you?
Yeah, so I was helping build a commercial mortgage brokerage with. Are you familiar with Jake and Gino?
I am.
So they have a company called Rand, and Rand Commercial Real Estate, and they were starting a mortgage business, Rand Capital. So they recruited me to help them start that business. And at the time, I was working as an analyst at a commercial real estate bank, as well as being a leasing agent. So I was kind of on the finance side and the management side. I have a bad habit of doing too many things at once, as most entrepreneurs can probably relate to.
Right.
But I was at the commercial mortgage brokerage in Tennessee, and I tell this story often of like, it was just very difficult. It was harder, like running a business is very difficult, but it was harder than it should be. I kept running into issues and walls that I felt that should not be this difficult to run through. And so I sat down and I was like, okay, what if I'm going to start a business or a separate business outside of this business? How do I make sure not to avoid these same pitfalls? And at the same time, I was communicating with my business partner, Brandon Thornberry, who's a very successful real estate investor here in Nashville. And so he's been flipping houses and purchasing multifamily in Nashville for 15 years or so. And he started doing his own hard money lending with his own capital. So he was lending out his own funds, and I had gotten in contact with him, and he was telling me about it. And he was like, there's a ton of demand for these types of loans. And I just kind of proposed the idea to him, like, if we raised capital and built a whole business out of this, is this something that could scale? And he was like, oh yeah. So that's the quick story of, I left the mortgage business. I put a business plan together, proposed it to Brandon, and that was about 2 years ago. And we've since scaled from, a couple 100,000 to now, I think we're at like 24 million total in loan volume in the last 2 years.
Wow, that's impressive. That's a lot of capital to raise. Let's talk really about that. Like, in 24 months from conception to 24 million in capital raised for hard money loans. I mean, you've not just got to build the business, you've got to build the investor base, you've got to build the systems. You got to then you have to build and vet all of your, and I'm telling you things you already know, but build and vet all of your clients and vet them and make sure that they're a good fit for your lending platform. What was the secret to your success thus far? I'm really super curious. That's a lot of movement in 24 months.
Yeah. So to make it slightly less impressive, the 24 million is the loan volume.
Okay.
And so that means we probably raised 13 million to do that loan volume.
That's still impressive. That's not something, there's a lot of people who have not raised $13 million in 24 months. So it's still impressive.
Yeah, I appreciate that. I just want to clarify, it wasn't 24 raised, but I was very lucky in a lot of those things. So for example, the commercial mortgage brokerage, my job was helping people source multifamily debt. And in order to do that, I would have to qualify the borrowers. So part of that process was asking for personal financial statements. So I built a huge client list of wealthy apartment owners that not only were in the real estate game and understood the space, but I knew their financial situation. So I pretty much was able to call that list for most of the capital that we raised. And we were very lucky to get 5 to 10 pretty heavy hitters that did a lot of that capital. And in the beginning, we were doing individual loans. So like if we'd have a $200,000 loan, we would get that from one investor who would fund the entire thing. And we were doing one individual loans. And then in July, we launched a debt fund. And that way we were able to raise all at once and made the systems a little bit easier. So I was lucky to have a network from the commercial mortgage brokerage, as well as at that same business, I was able to learn, the important things of a business, like systems, culture, people, just the things to do and the things not to do in terms of how to like effectively run a business. And then the vetting the clients, I'm trying to get all your answers at once. Vetting the clients, again, Brandon, he had been flipping houses in Nashville for 15 years. So he had a huge Rolodex of clients already, and we were able to tap into that network. So it may sound like a zero from nothing to very large very quickly, but a lot of the pieces of the puzzle were already in place, and we were just lucky enough to be able to tap into them. But it's certainly been, as I'm sure you know, it's been a grind for a while.
For sure. I mean, that's exactly, it's a great way to put it, is a grind. I think one of the key things I like in your story there is that you used all of the pieces from the previous experience. I think so often we get this like, hey man, I'm gonna own $100 million in apartment complexes the next 9 months. Ready to go. And you like 8 months in, you've got one complex, maybe if you're lucky, and you're defeated. But I think taking those small successes that you had along the way. I mean, again, having a Rolodex of people to call on that you already know are, capable borrowers on the, when you're in the mortgage brokerage side, that can then also help fund your guys' next venture here in hard money loans. Tell me about this. When you launched a fund, one of the things, or one of the hiccups I've commonly heard from investors, is that they want to know what they're investing in. How have you overcome that hurdle with the fund?
Yeah, I've also run into that hurdle for sure. And what I found is that a lot of the same investors that were very willing to fund, millions of dollars of loans on individual loans were not the investors that wanted to invest in the fund. It was a different investor profile. And that's really been the solution that we found. And we still do the fund and individual deals. So we've got our Rolodex of investors who like funding individual deals. And then we've got investors that prefer the fund. And our solution to that hurdle has really just been, each type of investment has its pros and its cons. And to identify the user profile that prefers one versus the other. And we found that experienced real estate investors that are more active, more people probably like yourself, Sam, they prefer to do the individual deals. They prefer to know exactly what they're investing in. They want to vet the deal. They want to be involved. Whereas the folks that prefer the fund are more so retiree folks, people that are investing through the self-directed IRA, people that are doctors or lawyers or dentists, and they don't have enough time or they don't have the experience to vet the deal. And they just want to know that they trust you and that you're an experienced operator. So for the fund, we target a different type of investor usually. And then for the individual deals, we target people that want to be more involved.
That's a strategic shift. How did you identify those investors maybe that wanted to be part of the fund? I know you kind of found out what their profile kind of looked like, but then identifying and then going after that particular investor type is another skill set altogether. How did you do that?
One of my favorite sayings is, I need to shake as many hands as possible. So just going to events, shaking as many hands as possible, asking for introductions. And we identified it just by looking through our investor list and say, okay, these are the people who invest in the fund. These are people that invested in individual deals. What's common and different about them? And it was very evident that like 80% of the people in the fund fit that user profile. So now when I'm talking to people, for example, I was at family, I was home for Thanksgiving and Christmas, and my parents are in their 60s, they're retired, and family friends that I'd never even thought would be investors. When I was telling them about what I was doing, they're like, oh, we're about to retire. We may be interested in the fund. And I was like, oh, like you kind of, now that you know that that's the user profile, you start looking for that individual, and it takes time, but it's just a matter of shaking hands and calling people.
Right. No, I like that. And I think like you said, for the right investor profile, it kind of demystifies challenge of investing in individual deals, right? For your retiree, for the person looking to clip a coupon, they don't want to vet individual deals. They don't want to think about it. They don't want to sign the paperwork on every deal. That's just a lot of work.
Yeah.
But where it's like, I think about my parents in that regard. It's like, they don't want to deal with that. But, getting a set percentage return, great. Okay, thanks. She calls me all the time. Is this really my money? Is that ACH money? Yes, Mom, it is. That's not what Mom sounds like, but I think that's a really, really powerful thing there, is to identify those different investor profiles. You've gone from running or working, I should say, in the trenches, right? Being a mortgage broker on the commercial lending side to now really running a full-scale business. How have you effectively transitioned from the kind of worker bee role to the business owner role?
Yeah, it's really been an evolution, especially over the last like 6 months. We for the first year and a half, it was just me and my business partner Brandon, and now we have 2 employees, Jonathan and Sarah, and they're awesome. And it's been, I'm naturally, I work all the time. I'm naturally wake up, I joke that I relax by working, or like I relax by being productive.
Right.
So it's been an evolution to like realize I don't need to be working every second of the day. I more so need to focus on helping my team get things done. And a tip that someone gave me was have a to-do list, and there's 3 sections in the to-do list. The first section is high leverage things that you enjoy. So like really impactful things that you enjoy. The second is things that need to get done. And the third is things I need to delegate. So anything that is not in those first 2, you'll realize that third section tends to be the same types of work. And then you can package that and then hire someone to do that work. And that's been really impactful for me. But it's been a mental shift to think about, like, it's okay if I'm not working 12 hours a day, as long as what I need to get done gets done, or like the team gets done.
Right. No, that's very powerful, and that's a difficult transition, I think, for all of us. At times in our careers, where it's like, okay, wait, like I've got to step back and stop doing and start planning, and then get other people to start doing in my stead, and that can be really challenging. Tell me this, Will. Right now there's a lot of turmoil in the markets, especially on the debt side of things. The housing market has theoretically cooled off. I don't even know what that means anymore. But you guys are at the forefront of that. So I guess, what are you seeing? What's your take on the market right now, and how has your lending shifted in the last 12 months?
Yeah, it's funny. I listen to a lot of YouTube channels and read a lot of articles about the housing market and supply and demand and stats. And after a while, I kind of realized, like, we're so close to the market that, like, what we do every day to day is actually better information than I'm reading online. So it's like, I not that I've stopped reading it, but I had that thought recently of like, a lot of these reports aren't as helpful as my daily job. But overall, yeah, there's been a significant slowdown in the market with interest rates at 6 to 7%. There's just a lot less buyers. And I'm a big believer in, as long as the cost of capital is going up, meaning as long as interest rates are going up, valuations are going to go down. It's very simple to me in that regard. And here in Nashville, we've probably seen a 10 to 15% decrease in housing valuations, and the supply on the market's doubled. And the recent closings are going down quite quickly. So there's a very evident shift in the market. Luckily, we launched our lending business not necessarily expecting that to happen, but we knew that people were taking too much risk and there was too much euphoria, especially in the housing market. So a lot of our loans were very low leverage, with very financially sound borrowers and locations that we know really well. So my opinion on the market is, I don't know what's going to happen, but as long as the cost of capital goes up, valuations will continue to go down. And as soon as the cost of capital levels out, the market will level out. As soon as the cost of capital goes down, the market will go back up. That's, I guess, don't fight the Fed is the famous saying. In terms of what we're doing, we're paying a very close eye on recent comps. So like something that sold 3 months ago, we're almost not that we're not considering it, but we're discounting it if it sold 3 or 4 months ago. We really want to see things that sold in the last 30 days to calculate what we think the valuations will be. We really prefer lower leverage deals. So in December, our average loan to expected ARV was like 45%. So we're extremely low leverage. And then we've recently started implementing this a lot, is the borrowers we lend to, we want them to be strong financially. So we want to see their liquidity. We want to make sure they have an ample amount of liquid reserves.
That makes a lot of sense. What are you guys seeing on the hard money lending side of things? And I know it's probably different for each borrower, depending on liquidity, skill, all those things, asset they're buying. But like, what's a good kind of, this is where you guys see the average loan terms going out at right now on a hard money side?
Ours have been the same since we started.
Wow.
We're at 12% interest and 3 points, 12% interest, 2 to 3 points, depending on the term. Our longest loan term is 6 months. And then we'll lend up to 100% of purchase price. We're a little unique. We don't lend on rehab funds, but we will lend up to 100% of purchase. So we're 12 and 3, 6 month, up to 100% of purchase. And I'd say that's right about normal. I've seen some raise rates and some pull back on leverage, but we've not really changed at all.
Right. Yeah, I've seen and heard some at 4 and 14 at this point. So it starts to get pricey on the money lending side of things. Tell me about this. You said, I think you said, we talked about this off air. You said you own 50 units of your own. What are those? Are those all individual, townhouses? Are they duplexes? Is it a complex? What's it like owning and running 50 units as well while you run this full-time business?
Exhausting. I'll clarify. I own, so it's 2 houses in Texas. It's an 18 unit in Knoxville, and then a 32 unit in Paris, Tennessee, which you may know. I like to clarify because people shout out unit counts all the time. I own the 2 houses outright myself, and then I'm a 25 to 30% owner in the apartments. So I like to say I'm like a 30% owner in 52 units. So, I like to clarify that.
Right. No, that's great though. I mean, that's still a lot of moving parts. How did you take those down as a 30% owner on the apartment complex? How did that deal work out?
Yeah, luckily, just with the 18 units, it's me and then a small handful of partners, where me and one other partner are the majority share because we operate the business, and then the others were kind of in ratio of how much they invested, and then we each invested ourselves. And then the 32 unit was just me and two other partners. So I was lucky enough to have kind of that same Rolodex of investors that know and like me well enough to bring a lot of the capital, and then I do all the legwork. Like the 32 unit, my partner found, and it's a disaster. I mean, it's like as bad as a property can get. We bought it for $25K a unit, and that's what it's worth. And a partner brought it to me who's much more experienced than I am, and he said, "This is a great deal, but I don't want to deal with it." He's like, if you'll manage it, if you'll be the asset manager, oversee the property manager, help raise the capital for it, I'll give you a large chunk of it, but I don't want to deal with it. So he's a 40% owner, and he did a lot of the help with getting the deal, sourcing debt and things like that. But I run the day to day, and it's a nightmare.
Wow. Would you do it again?
Well, we bought it in May.
Okay.
So we're 8 months in. I'll have to do this podcast again in a year and let you know. But I'm very, very confident that it will turn out to be great. But we're right in the midst of the storm right now. So we're renovating everything. It's 50% occupied. I mean, there's bed bugs, there's meth. It's a whirlwind.
It's a whirlwind. Wow. Well, good for you for taking that on. That sounds scary from this side of the microphone. One last question for you. What is one mistake? Let's talk this on maybe on the lending side of things. What's one mistake maybe that you've made on the lending side of things that either you could help our listeners as borrowers or as lenders avoid?
A good question. On the lending side, I think a lesson that we've recently learned, and that's why I brought up the borrower liquidity piece, is don't overextend yourself. We knock on wood, we haven't had any deals go bad. We haven't foreclosed on any deals, but we've had a couple borrowers run into situations where they had too many projects going at once, right, and that put a really big strain on their liquidity. So we've learned that as a lending business to keep a very, very close eye on borrowers' liquidity. But in terms of people who are borrowing, don't be too have a pretty healthy amount of reserves, and don't be too optimistic with how thin you can spread your capital. Both those situations will work out, and we've gotten solutions to those. But that's been a recent lesson of liquidity can go quickly.
It can. Will, thank you for coming on the show today. I certainly appreciate it. It was a pleasure to have you on. Learned a lot from you. If our listeners want to get in touch with you and learn more about you, what is the best way to do that?
Yeah, so our website is urbangatecapital.com. If there's an investor form and a borrower form, and then if you want to email me, my email is will@urbangatecapital.com. Will@urbangatecapital.com. We'll make sure we include that there also in the show notes. Will, thank you again for coming on today. I certainly appreciate it. Thank you, Sam. It's been great.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.